Good day everyone, we are the Group 7 and today we're going to discuss the Chapter 7, Accounting for Merchandising Activities. But before that, please allow me to introduce myself and my group mates. I am Maxine Sofia Bitamayo, together with my group mates Ruana Albitoy, Yeshashin Tigo, Brix Numantas, and Marilyn E. Mangipol. Nature of merchandising business. In the previous chapters, emphasis is given to accounting for the activities of service companies which generate revenue by rendering service. Its revenue may be in the form of commissions, service fee, or management fee. A merchandising company, on the other hand, generates revenue from selling of merchandise or goods that it purchases from other companies. Its major activities consist of buying and selling of merchandise. Normally, the entity purchases goods or merchandise on a wholesale basis either from manufacturer or another wholesaler and sells the same at a profit. The revenue of the merchandising company is termed as sales. The goods that are acquired for sale by an entity are reported as merchandise inventory and classified as current assets. However, upon sale of this merchandise, their cost is transferred to an expense account, cost of goods sold. A merchandising company is also different from a manufacturing company. A manufacturing company purchases material and transforms them into finished product, a form different from the purchased materials. For example, a merchandising company purchases leather material and sells the same as leather materials. And a manufacturing company purchases leather material and transforms the materials into bags or shoes. Retailers and wholesalers. Merchandising companies include both retailers and wholesalers. A retailer is a business that sells merchandise directly to the consumers or public. The other type of merchandising company is the wholesaler. Wholesaler buy large quantities of merchandise from several different manufacturers and then resell this merchandise to many different retailers. As wholesalers do not sell directly to the public, even the largest wholesalers are not well known to most consumers. Nonetheless, wholesaling is a major type of merchandising activity. Accounting procedure for merchandising entities, the procedures in accounting for the financing and investing activities as well as marketing and administrative costs applied to a merchandising concerns are the same as those applied to service and manufacturing concerns. Operating cycle of a merchandising or trading business. The series of transactions through which a business generates its revenue and its cash receipts from customers is called operating cycle. The operating cycle of merchandising company consists of the following transactions. First, purchase of merchandise either in cash or on credit basis. Payment of account to suppliers. Sales of merchandise also either in cash or on account basis. And last is collecting of accounts receivable from customers. The operating cycle of a company that sells on credit is generally longer than that of an entity that sells exclusively on a cash basis. For instance, an entity may extend to its customers a credit period of 60 days, which means the customers are given 60 days within which to pay their accounts counted from the date of sale. As the word cycle implies, the sequence of transactions is repeated continuously. A portion of the cash collected from customers may be used to purchase more merchandise, and the cycle begins anew. This continuous sequence of merchandising transaction is illustrated below. Ato makita diri ang cash, inventory, and account receivable, purchase of merchandise, payment of debt to suppliers, sales of merchandise to customer, and collection of the receivables. Basic concepts of inventory accounting in a merchandising business. Inventories are asset items that a company holds for sale in the ordinary course of business or goods that will use or consume in the production of goods to be sold. A merchandising concerns, such as restaurants, usually purchases its merchandise in a form ready for sale. It reports the cost assigned to unsold units left on hand as inventory. Only one inventory account, merchandise inventory, appears in the financial statement. Inventory cost flow. Companies that sell goods report inventory and cost of goods sold at the end of cash accounting period. The flow of the cost of company is as follows. Beginning inventory plus the cost of goods purchased is the cost of goods available for sale. As goods are sold, they are assigned to cost of goods sold. These goods that are not sold by the end of the accounting period represent ending inventory. And here is the illustration that describes these relationships. Company use one of the two types of system, the perpetual system or the periodic system. Accounting for merchandising transactions using the perpetual inventory system. A perpetual inventory system continuously tracks changes in the inventory account. That is, a company records all the purchases and sale of goods directly in the inventory account as they occur. The accounting features of perpetual inventory system are as follows. First is purchase of merchandise for resale or raw materials for production are debited to inventory rather to purchases. Freight in is debited to inventory, not purchases. Purchase return and allowances and purchase discount are credited to inventory rather than to separate accounts. Cost of goods sold is recorded at the time of each sale by debiting cost of goods sold and crediting inventory. A subsidiary ledger of individual inventory records is maintained as a control measure. The subsidiary records show the quality and cost of each type of inventory on hand. The perpetual inventory system provides a continuous record of the balance in both the inventory account and the use of perpetual system was limited to entities and maintained high-value inventory items in small quantity, such as automobile and real estate dealers. In Figure 7-1, Inventory Subsidiary Ledger Account, and we can see here the item, description, location, primary and secondary supplier, and inventory level, also the purchase, sold, and balance. Accounting for purchases of merchandise. When a company using the perpetual inventory system purchases merchandise and account, it debits the inventory account for the acquisition cost of the merchandise purchased to reflect an increase in the amount of inventory and credits the account payable account to reflect an increase in the amount owned by the supplier. Example, the Santos Wholesale Electronics purchase inventory for inventory shows in Figure 7-2 requires Santos to record the company's purchase of merchandise from Maxim Manufacturing on November 10 with this journal entry. Transportation costs. Inquired by a buyer, transportation costs are sometimes incurred by a merchandising company when it acquires goods, and this cost is included as part of the acquisition cost of inventory. When the buyer is responsible for the shipping cost, it is referred to as FOB shipping point. An example of an invoice that specifies the shipping and payment terms is shown in Figure 7-2. Assume Santos, which is the buyer, pays $1,260 to the freight company on November 11 for transportation costs on the 100 disc drives purchased from the Maxim Manufacturing, which is the seller, and Santos makes this journal entry to record the payment of $1,260. And we can see in the Figure 72 invoice for inventory purchase, the seller, its address, contact info, the date, its invoice number, and where or whom to ship. This inventory shows the salesperson, shipping method, shipping terms, delivery date, payment terms, the quality, number of items, its description, the unit price, discount, and line total. When seller is responsible for shipping costs, it is required to as FOB destination. Instead of shipping terms stated in the invoice in Figure 7-2, assume that the seller, Maxim Manufacturing, is responsible for paid the $1,260 transportation costs. In this case, the transportation cost would be considered an operating expense of the seller, and Maxim Manufacturing would debit an expense with the title fit out expense as follows. Purchase returns and allowances. A purchaser is dissatisfied with some or all of the merchandise purchased because the merchandise was, for example, manufactured poorly, the wrong merchandise was shipped, or the merchandise was damaged during shipping. When such circumstances are encountered, the purchaser and the seller can remedy the problem by agreeing to treat the value of the unwanted items either as purchase return or as purchase allowance. With a purchase return, the purchaser ships the unsatisfactory merchandise back to the seller and receive a credit against the amount due equal to the invoice price of the returned merchandise. With the purchase allowance, the purchaser retains the merchandise and the seller reduces the amount that the purchaser owes the seller for the shipment, in effect during the sales price. As an example of a purchase return, assume that on November 15, Santos returned 10 of the 100 disc drives purchased on November 10. Santos has not yet paid Maxim Manufacturing for the goods purchased. Accordingly, Santos makes the following journal entry on November 15 to record the purchase return. To record a purchase return of 10 disc drives to an invoice price of $2,100 each to Maxim Manufacturing. This entry reduces the inventory account balance and reduces the amount owed. When the purchaser and the seller reach agreement on how to handle a purchase return, they also must agree on which party pays the freight charges on the returned merchandise. Usually, the seller pays freight charges when goods are returned, in an attempt to maintain a positive customer's relationship and to increase the likelihood of future repeated business. Purchase discounts. Credit period. When merchandise is sold on credit, the credit period is the maximum amount of time, often stated in days, that a purchaser can make to pay a seller for purchased items. A typical credit period of a wholesale distributor is 30 days. The credit period is frequently described as the net credit period or net terms. Merchandiser use the notation followed by the number of days in the credit period to designate the time period that the customer can take before paying cash for purchased goods. For example, N over 30 indicates a credit period of 30 days, and N over 45 indicates a credit period of 45 days. To encourage the early payment of unpaid bills, many firms offer their customers a cash discount if payment is made within a designated discount period. A cash discount or sales discount is the amount that a seller deducts from invoice price if payment is made within the allowed discount period. Some refer to the cash discount offered to customers as a quick pay incentive. Sellers usually state cash discount as a percent of the invoice price. The discount period is the maximum amount of time stated in days that a purchaser has to pay the seller if a purchaser wants to claim the cash discount. The discount period is always shorter than the credit period. Most merchandisers use the format cash discount percent over discount period to designate the cash discount and the discount period. For example, 1 over 10 indicates a cash discount of 1% of the invoice price and a discount period of 10 days following the invoice date. Finally, merchandisers usually combine the notation for the cash discount and the discount period with the notation for the credit period. For example, 1 over 10 and N over 30 represents a cash discount of 1% if paid within 10 days of the sale with a total credit period of 30 days following the date of the sale. To illustrate, let us return to the Santos example in which Maxim Manufacturing and Santos agreed on terms of 2 over 10 and N over 30 for the sale on November 10. Santos deducts 2% of the 210,000 invoice price, 4,200 if it pays Maxim on November 20. In that case, Santos pays 205,800 cash, computed as 210,000 times 1 minus 0.02. If Santos pays Maxim after November 20 but no later than December 10, the amount that Santos must pay is 210,000. After December 10, the 210,000 amount would become overdue and often incurs additional interest costs depending on the invoice terms. And the figures 7 to 3 illustrate this example.
Good day everyone. My name is Madeline Imangipol and today I am going to discuss about accounting for merchandising activities. This topic explains how businesses record buying and selling of goods, how discounts work, and how these transactions affect financial statements. So first, let's discuss purchase discounts. These are discounts given to buyers if they pay their suppliers early. Businesses use this to manage cash flow better. When you see terms like 2 out of 10 and out of 30, it means the buyer gets a 2% discount if payment is made within 10 days. If not, the full amount must be paid within 30 days. In accounting, purchase discounts reduce the actual cost of inventory. Under the periodic system, we record this using a purchase discounts account. Under the perpetual system, the discount is directly credited to Let's look at a real example. On November 10, Santos bought these drives worth 210,000 pesos. Later, goods worth 21,000 pesos were returned, leaving a balance of 189,000 pesos. If Santos pays on November 20, which is within the discount period, they get a discount of 3,780 pesos. The journal entry would be debit accounts payable is 189,000 pesos and credit cash is equals to 185 and 220,000 pesos and credit merchandise inventory is 3,780 and so if Santos pays late on November 25, the discount is lost and they must pay the full 189,000 pesos, increasing the total cost of the purchase. Now, let's look at the seller's side. Sales revenue is recorded when the goods are delivered, not when cash is received. In a perpetual inventory system, every sale requires two journal entries. First, record the sale, debit accounts, receivable, credit sales revenue, and the second is record the cost of goods sold, debit cost of goods sold, credit merchandise inventory. This ensures that inventory records are always updated. Next will be returns, allowances, and sales discounts. Sometimes customers return items. For this, we use sales returns and allowances, which is a contra revenue account. A sales return happens when customers send the goods back. This reduces accounts receivable and increases inventory. A sales allowance is a price reduction for damaged or defective goods that the customer keeps. Sales discounts are also contra revenue accounts. These discounts are computed based on the net amount, meaning returns are deducted first before applying the discount rate. In conclusion, all of these details are important because they affect gross profit, inventory valuation, and net income. Accurate merchandising accounting helps businesses make better pricing decisions and produce reliable financial reports.
Good day, everyone. I am Yashashin Go, and I will be discussing inventory systems and the accounting for merchandising transactions.
A physical inventory involves counting the actual merchandise on hand at least once a year. This process verifies the accuracy of inventory records maintained under the perpetual inventory system. Any difference between recorded and actual inventory is known as inventory shrinkage. Even though inventory is continuously updated, a physical count is still necessary to confirm accuracy. This process helps identify losses that may not be recorded in the books, and inventory shrinkage can occur due to theft, spoilage, breakage, or shoplifting. And conducting a physical inventory helps maintain reliable financial records. So for the inventory adjustment and closing entries, inventory records are adjusted to match the results of the physical inventory count. Inventory shortages are recorded by debiting costs of goods sold and crediting merchandise inventory. At the end of the period, revenue and expense accounts are closed. So when differences are found during the physical inventory, adjusting entries are made to correct the inventory balance. These adjustments ensure that cost of goods sold reflects the true cost of the inventory used. Closing entries are then prepared at the end of the accounting period, and this process completes the accounting cycle and prepares the books for the next period. This page presents sample journal entries for Trinity Company under the perpetual inventory system. Each transaction is recorded immediately, including both sales and the related cost of goods sold, and purchases are added directly to the inventory account along with freight charges. These entries show how inventory and costs are kept updated at all times. This slide explains how the periodic inventory system works. Under this system, when merchandise is purchased, the cost is recorded in the purchases account, not directly in inventory. So when merchandise is sold, only the sales revenue is recorded and no entry is made for cost of goods sold at the time of sales. So inventory records are not updated directly, so there is no inventory subsidiary ledger. At the end of the year, a physical count of inventory is done, and the cost of goods sold is computed using beginning inventory, purchases, and ending inventory. So, for example, on November 10, Santos purchased 100 disk drives at 210,000 pesos each, and the journal entry debits purchases and credits account payable for 210,000 pesos. This slide discusses additional purchase-related transactions under the periodic inventory system. First, transportation costs paid by the buyer are recorded in the freight-in account, not inventory. So, for example, on November 12, Santos paid 1,260 pesos for freight, which was recorded as freight-in. Next, if merchandise is returned,
the buyer records it under purchase returns and allowances, which is a contra purchases account. For example, on November 15, Santos returned 10 disk drives, reducing account payable by 21,000 pesos. Lastly, when a buyer pays within the discount period, a purchase discount is recorded. This slide explains payment after the discount period and sales under the periodic inventory system. If payment is made after the discount period, no discount is allowed. For example, on November 25, Santos paid the full 189,000 pesos to account payable. For sales under the periodic inventory system, the seller records only one journal entry to recognize sales revenue, and there is no immediate entry for cost of goods sold. For example, on December 12, Santos sold 15 disc drive at 2,800 pesos each, with credit terms of 1 over 10 and n over 15, and the journal entry debits account receivable and credit sales revenue for 42,000 pesos.
Good day, everyone. I'm Brix P. Lumantas, and for this presentation, I will be discussing sales returns and allowances and sales discounts under the periodic inventory system. These topics are important because they explain how merchandising businesses properly records returns, discounts, and collections. Understanding this helps us see how sales revenue is adjusted and why inventory is only updated at the end of the period in a periodic system. Sales returns and allowance occur when customers returns defective goods or receive a price reduction. Under the periodic inventory system, only one journal entry is recorded for these transactions. This entry focuses on reducing sales revenue and the customer's balance. Unlike the other systems, the periodic approach does not immediately adjust inventory, which simplifies recording during the period. When recording a sales return, the company debits sales returns and allowances and credit accounts receivable. This means sales revenue is reduced and the amount owed by the customer decreases. This method ensures that the financial statements reflect the true net sales after considering returns and allowances. In the given example, Santos recorded the return of 5 disk drives from the computer outlet store. Each disk drive was sold at 2,800 pesos, resulting in total return of 14,000 pesos. This transaction clearly shows how the periodic system records the return by adjusting sales and receivable only without affecting inventory at that time.
If payment is made after the discount period, no discount is allowed. In the December 27 entry, cash is debited and accounts receivable is credited for the full amount of 28,000 pesos. This emphasizes the importance of paying on time to benefit from discounts. Sales discounts are incentives given to customers to encourage early payment. The journal entry for recording cash collections is the same under both periodic and perpetual system. If payment is made within the discount period, sales discounts is debited. This account is contra sales account, meaning it reduces total sales revenue. In December 22 example, the computer outlet store paid within the discount period. Cash was debited for the amount received. Sales discounts was debited for the discount allowed, and accounts receivable was credited for the full amount owed. This shows how discounts reduce revenue but improve cash flow. If payment is made after the discount period, no discount is allowed. In the December 27 entry, cash is debited and accounts receivable is credited for the full amount of 28,000 pesos. This emphasizes the importance of paying on time to benefit from discounts. This slide summarizes how purchases and related transactions are recorded under the periodic system. Purchases are recorded in a purchase account. Freight charges paid by the buyer are recorded as freight in, and returns or allowances are recorded in purchase returns and allowances. Purchase discounts are also recorded separately as contra expense accounts. In periodic inventory system, inventory and cost of goods sold are recorded during year-end closing. A physical count is conducted to determine the actual inventory on hand, and the difference between book and physical inventory is adjusted, ensuring accurate financial statements and correct computation. For sales transactions, revenue is recorded without updating inventory. During the period, sales returns and allowances reduces revenue, and collections may include discounts depending on the payment timing. Freight charges are recorded depending on whether they are paid by their seller or buyer, showing proper cost classification.
To start, let's look at the additional data for Starlight Sound Stereo Center as of December 31. This is the information we need to correct our accounts before finalizing our reports. For example, we have 4,000 pesos in interest revenue that we've earned but haven't collected yet. On the physical side, we've counted 402,000 pesos in inventory and 1,000 pesos in supplies still on hand. We also need to account for things that expired or wore out, like 10,000 pesos in insurance and 6,000 in depreciation. Finally, we have to record unpaid expenses like 4,000 pesos in wages and 2,000 pesos in interest. With all that data gathered, the goal for Starlight Sound Stereo Center is to complete the accounting cycle. This involves preparing the adjusted trial balance and the formal financial statement to show the true health of the business at the end of the year. The next several slides walk us through the actual calculation. On slide 24, we see the initial solutions for our entries. Slide 25 moves us into requirement 2, which organizes those entries into a trial balance. Slide 26 through 28 break down the three main financial statements: the income statement, the statement of changes in equity, and the balance sheet. Finally, on slide 29, we complete requirement 4 by closing out the temporary accounts so the business is ready to start a new year with zero balances in its revenue and expenses accounts. Now, we move to an essential part of merchandising in the Philippines, the value-added tax or VAT. Under Philippine law, a 12% VAT is imposed on the purchase and sale of goods. It's important to note that VAT increases the amount paid, but it does not increase the actual cost of the goods for the business. When we buy goods, we record the VAT as input tax, which is a debit. When we sell goods, we collect VAT from the buyer and record it as an output tax, which is a credit. To see how this works in practice, let's look at Sun Trading. In this example, they use the periodic inventory system. We are going to track their purchases and sales while including that 12% VAT in our journal entries to see how the money flows between the buyer, the seller, and the government. On this slide, we see the bottom line of VAT. Sun Trading paid 6,000 pesos in VAT when they bought their goods, but they collected 7,200 from their customers. They keep the 6,000 pesos to cover what they already paid and remit the remaining 1,200 to the government. This proves that the consumer, not the business, ultimately carries the burden of the tax. We also have to be careful with cash discounts. If Sun Trading pays within a 2 out of 10 discount period, the VAT must be adjusted to match the final discounted price paid.